Well, hello everyone, and welcome to today's webinar on pre-IPO studies for determining a discount for lack of marketability, and particularly the Valuation Advisors DLOM database. Our presenter for today is Brian Pearson of Valuation Advisors, who I will introduce in a moment. My name is Andy DeZamba, and I'm the executive editor here at BVR. Before I go into some of these housekeeping remarks, we wanted to launch a poll for you in the audience and just kind of ask you what DLOM methods do you use in estimating your discount. The poll is up now, and if you would please choose all that apply. We've done this survey the last few years, so it's kind of an interesting comparison to see. Anyway, while that's up, I'll remind you that your attendance today is eligible for 2 CPE credits. To receive the credits, you must complete and submit a brief survey on today's webinar at the conclusion of our presentation. The survey will appear at the end of the program, and there's also a link to it in your registration email, and it's also on the reading page for today's program. The survey will be active for 5 business days, and to fill it out, you need 3 4-digit CE codes. The codes for today's webinar are 6809, 7349, and 2611. Again, those codes are 6809, 7349, and 2611. I will announce the codes again later during the program. If you have any questions for our presenter, we'll take them in writing only. To do that, use the chat function on your screen. If you have any trouble with the audio streaming, please refresh your screen. That normally fixes the trouble. You can also access the webinar with your smartphone or tablet. We're very happy to have Brian Pearson back with us here at BVR. Mr. Pearson is the founder and president of Valuation Advisors, which is a firm that specializes in the valuation of private and public companies. He has over 21 years of experience in valuation and has over 10 years of Big Four experience, where he advised closely held business owners on various tax and financial matters, including business valuations. Mr. Pearson is the creator of the Valuation Advisors Lack of Marketability Discount Study, also known as a pre-IPO study, which is the largest study of its kind, and that's what we'll be talking about today. I'm going to close out the poll shortly, but certainly the most cited method is restricted stock studies, not surprising. Coming in second is pre-IPO study, is almost third. Option pricing, 14%. QMDM, the Chris Mercer model, 6%, and other also 6%. So these results pretty much track our polls. So thanks very much for that. And I will now turn the program over to our presenter for today, Brian Pearson. Brian?
Thank you, Andy. Good afternoon or good morning, everyone, if you're on the West Coast. I look forward to giving you an update on the Valuation Advisors, the DLOM database, and in particular, if you aren't a current user, hopefully after the presentation, you'll see kind of the value in using the database. If you're an existing user, what we're going to try to hopefully help you do today is see some of the other ways that you can use the database that you might not be using it for currently. I'm going to give you a brief overview of what I'm going to cover today. I'm going to start with just an overview of the database, including how we find the transactions that ultimately find their way into the database, and then how the discounts are calculated, and I think most of us probably know that. Secondly, we're going to address some of the older pre-IPO criticisms that really related back to the older studies that were done in the late 1990s and early 2000s. Then we're going to cover some frequently asked questions. I'm going to go over some of the recent database results for 2019, and then we're going to go through just a couple examples of different ways you can use the database, and then I'll summarize and obviously try to address any questions that you might have. So with that, let's jump right in. The Valuation Advisors DLOM database is over 15,300 pre-IPO transactions. It's the largest database for lack of marketability in the world. We have reviewed virtually every IPO in the U.S. and certainly some foreign IPOs in the U.S. over the last 25 years. The database is updated monthly with transactions from companies that went public during that month. So for instance, any company that's going to go public in January, we will have in the database the first week of February. We try to be very timely in making sure the database is updated within the first week of the following month. We review the registration statements that the company ultimately files as the final registration statement for their IPO. And then from that registration statement, we look for stock option and convertible preferred stock transactions when the company was still a privately held company. Any below market transactions are adjusted to their fair value based on the SEC's fair value guidelines, and all those transactions that are in the database have been adjusted if necessary. We capture transactions up to a 10-year time period, although about 10,000 of the transactions in the database are within a 2-year time period. So certainly there are a number of older transactions, but the significant majority of the transactions are in a relatively short time frame of the IPO, which is very helpful. If we move to the next page, page 3, why use pre-IPO data? I'm a big advocate, obviously. The holy grail of investing in value is the market. And we all know that, a stock market price is a price that's set by a number of buyers and sellers. Now, some people might argue the IPO price isn't necessarily quite as accurate, but nonetheless, it still is a market price set by a number of buyers and sellers, those being the company and selling shareholders, and the buyers being those that want to buy into the IPO. So it does represent an established market price. The other thing is that the pre-IPO studies kind of more closely actually represent the situation of a shareholder in a true privately held company, whereas some of the other studies out there are capturing liquidity for a company that's already public. And so to some extent, the pre-IPO transactions truly mirror a situation of the typical privately held company and the risks inherent in owning stock in those companies. The shorter the time frame to the IPO, the fewer uncertainties there typically are. And I say that in the context of we track transactions in our database during the first year in 3-month intervals, so 0 to 3 months, 4 to 6, 7 to 9, and 10 to 12, and then we start to track them in yearly increments beyond that. Clearly, the further away you are from the final IPO date, the more noise there might be with regard to a lot of things that can be going on with regard to the company. But it is interesting to note that a number of studies over the years have tried to look at the discount that is inherent, if you will, for lack of liquidity, let's say, not even marketability, just lack of liquidity. And in the 0 to 3 month time frame, if you were to look at our entire database, you're going to find it's typically in the 20 to 22% range, which is pretty consistent with most of the historical studies that have been done on other forms of lack of liquidity. When you start to go out further, for instance, you get into the 10 to 12 month time frame, you're typically going to see something in the 45 to 50% discount range. And that, once again, is not atypical, representing the risk involved in a privately held company versus a publicly traded company. So on the next page, we cover where do these transactions in the database come from. Once again, as I mentioned, we review the IPO prospectus, and those IPO prospectuses, in addition to containing the transactions that we use in determining the discounts, they also contain a wealth of other information that in the course of doing your valuation work is very helpful. So one of the things that you can think about is, aside from just providing a DLOM numbers for you, you can also search the database just to find companies that have gone public in an industry where you may be doing evaluation. And then, of course, you can always reference back to the filing documents of that company, and there's significant information in there. So but for example, next week, Casper Sleep is going to go public. And I happen to just pull up their prospectus and just take a look. The S1A, which was filed this past Monday, which is kind of the final before you get to the final IPO filing, had some interesting just disclosures, the kind of things that if you were valuing a chain of sleep stores, let's say, you might be interested in. So, for instance, the global sleep industry is a $432 billion industry. The U.S. sleep industry is about a $79 billion industry, and the projected 5-year growth rate is 6.3%. And then, for instance, mattresses and pillows and PJs, they break out the global value for that. So global value for mattresses was $81 billion, for pillows is $1.5 billion, and pajamas is $32 billion. You know, when you see those different commercials on pillows, that you can see why that market is so big out there. Another company that's going to go public this week is Reynolds Consumer Products, and I'm sure you're familiar with their products, those being like Hefty bags and a Reynolds wrap. So those would be two good examples of companies, one this week and one next week, that'll go public, where we will drill into those prospectuses, find any pre-IPO transactions, and then obviously calculate the discounts. And I'll point out something that's interesting, going back to Casper for a second, that oftentimes this can be the case where Casper started in the year 2014 and it's going to go public in the year 2020, so it's a pretty amazing trajectory of growth. And yet it's the type of company that also fits this recent profile of companies that have been going public, which is rapid growth but losing money. So in 2017, their revenues were about their revenues were about $250 million. And in 2018, their revenues were $357 million. But both years, they lost in the neighborhood of $70 to $90 million of operating income. So here you've got a situation where a company is growing rapidly, losing money, and yet still being able to be funded by the public markets. Now, another note I'll make on Casper, and I'll make this in the context of the database, is that over the years, the types of companies that have been able to go public has changed, and that, to some extent, that does influence the discounts and your analysis of information. So more recently, certainly in the last 3 to 4 years, you've seen a number of companies that have been able to go public that are growing fast and yet losing money. And so obviously you think of Casper, you can think of Uber, you can think of Lyft, you can think of Peloton, those types of companies. Clearly companies with a large user database but still not making money. By comparison, if you were to go back into the 90s, you would find that up until 1999, but in the probably late 80s, early 90s, it was much easier for companies to go public only if they were profitable. So the dynamic of going public has changed a little bit. That's also changed the discounts over a spectrum of time, and that's something you need to kind of just think about in the context of your company that you're valuing. So on the next page, what we're going to show you is, this is a screenshot taken from an IPO in March 2019 that most of us are probably familiar with. This is Levi Strauss & Company, the jeans company. They had an IPO in March, and they did some stock repurchases in February, or within the 3-month time period that we use. Those repurchases were done at $17 a share. I should say the repurchases were done at $14.88 a share. The IPO price was at $17 a share. So this would give you a pretty good example of a stock transaction close to the IPO date. And then on the next slide, what you'll see is we calculate, obviously, how that discount was arrived at in the time frame. So this would function, obviously, as a 0 to 3 month transaction and a stock transaction in the database. As you search the database, you'll also see at the bottom of the page kind of the output, so to speak, for a particular transaction. In this case, the Levi Strauss transaction shows you other information about the company. The net sales were about $5.5 billion, and I'm looking on the financial data on the right-hand side. Assets, $3.5 billion, and operating income of $500,000. This is a very profitable company that it did an IPO. And so very similar to those of you that use deal stats currently, what you can do with the Valuation Advisors DLOM database is you can obviously search it a lot of different ways, and you can keep or delete transactions, recalculate what you want, and then shoot that over to Excel, and from there slice and dice it and play with it however you want. But it certainly gives you a very good way to paper your file, your valuation file, with regard to how you arrived at one maybe piece of your puzzle for lack of marketability. So this is an example from the database. Next, I'm going to really cover some of the prior criticisms. And in particular, I want to just point out that the prior criticisms were really mostly focused on the older Willamette and Emory studies, which really haven't been updated probably since the year 2002. So as I say older, they're getting very old at this point. But nonetheless, some of these criticisms still continue to get rehashed. And so I want to kind of go through them and just point out some of the fallacy in those criticisms in the context of our database. So cheap stock transactions are situations where you have an insider and an executive that's issued stock at a price below the fair market value of the stock, and obviously, what that would tend to do would be to inflate the discounts. In the Valuation Advisors database, we only include transactions that have been SEC reviewed and fair value adjusted, so there are no cheap stock transactions in the context of the database. And if there's disclosure in there and it's not adjusted, we adjust for any compensation expense to the extent we have decided that it's a reliable transaction we can include in the database. So that's one criticism that obviously is not part of our database, and I don't think our database has ever been criticized in that context. Another one of the criticisms is the double counting of the discount. And this criticism has been made of all the studies, including ours, and I just want to point out how this is arrived at. So when you have a company that goes public and they have a transaction prior to going public in the context of stock or options, oftentimes it's the valuation for the stock or the option might have been done by an accounting firm, a valuation firm, where they're using the P-worm method to arrive at value. And in the context of using P-worm, they have to consider a lack of marketability discount. So for instance, if the equity value of the company was $10 per share and there's a 30% DLOM, then the reported transaction value will be $7 per share. And so ultimately, if the company went public later after the transaction, let's say that transaction was in the first 3 months of going public, 3 months later they go public at 12, our database is going to show the discount as the difference between 12 and 7. And some people have criticized that and said, well, the transaction already had a 30% discount in it. And that is true, but nonetheless, keep in mind, even if that there wasn't a implicit discount, so to speak, the difference between 12 and 7 still only represents one discount. It's just in the context of that prior transaction, the valuation party took the discount on the reported transaction, which is obviously from an accounting standpoint the correct thing to do, and the way we report that is conceptually still correct. In other words, it's just the difference between the eventual IPO price and the transaction price, which was the recognized, quote, fair market value for that interest in the company. Because keep in mind, the fair value of the whole company, in theory, would have been $10, but you're not buying the whole company, obviously. So you're buying much less than the whole company. You're getting shares of much less than the whole company. The next criticism is that the IPO prices are underpriced. And this has been a pretty consistent criticism for IPOs for a long time. In other words, the price is set low by the underwriter because the underwriter wants to have a successful offering. And that somehow that's obviously important to the underwriter, probably considerably less important to the company. There was just an article in the Wall Street Journal this past month on this issue where in 2019 there was about $3.8 billion of theoretical first-day gains that were lost by companies doing IPOs because the stock price finished higher on the first day from the IPO price. And that was mitigated somewhat by the fact that toward the end of the year, there were several tech IPOs that lost $1.7 billion. In other words, they went public and finished below the IPO price. My take on this is that larger companies typically probably have a little greater pricing power with regard to the underwriting process, typically because they're more well-known, there's more demand for their shares, and in a theoretical IPO pricing range, they can probably price at the higher end of the range, versus a smaller company going public that doesn't have that level of flexibility. And so what you might be more likely to see is, unless it's a very much popular company in demand, you're not going to see as much of a first day pop typically with a large company as you might with a small company, to the extent you see any first day pop. Oftentimes you don't see that, and sometimes you'll see prices fall as well. But that said, it's kind of illogical if you think about it for a company selling its shares to underprice the offering. And let me explain why. The majority of the IPOs we see, it's not selling shareholders. It's typically the company selling shares. And so if you're the company selling shares, you want to raise as much capital as possible. You don't want to leave money on the table, so to speak, because more often than not, companies are going public, are startup companies. They want and need as much capital as possible to grow. So it's certainly not in their best interest to leave any money on the table. And the other thing is that the price is typically set over a period of time from the standpoint of the company normally does a roadshow with the underwriters, and the roadshow is really to go out and promote the company and to gauge the level of demand. It's kind of like if you're watching the Super Bowl this weekend and you're trying to set a line on the game between the 49ers and the Chiefs, and that's what all the casinos have to do, right? They have to set a line, and then there's the first bet, and all of a sudden, betting back and forth, and the line moves. The underwriters are trying to gauge the level of demand and obviously the level of supply. That means what number of shares the company wants to sell. So once again, they're trying to come up with something that makes sense and that truly represents kind of the market of buyers and sellers. In a situation occasionally where there's excess demand, in other words, it's a hot offering, there's a lot of people that want to buy into it. You can think of a Facebook scenario. They might raise that price. They might raise the IPO price, and obviously then the company's going to get more money. The converse of that is a situation where the company has less demand, but still needs to go public. And I've seen this happen a number of times where the company will lower price considerably just to go public because they need to lower a price at a level enough that creates demand. But on balance, I think over time, these two things tend to even each other out. And for the most part, the market's pretty good about setting a price where you don't get much of a first-day pop of significance one way or the other, unless the company's decided they don't want to sell a lot of shares and there is excess demand. And that's the scenario you typically see where you get a large change in price. So let's take a look at another scenario, which is just the converse of this, which is that IPOs are overpriced. And I've gone through, on this slide, I've kind of gone through all the particular elements of, the fact that, IPOs aren't overpriced either. There's incentive on both sides to kind of get it right and not be greedy. So I think the concept of overpricing and underpricing does occur sporadically, but for the most part, as criticisms, I think they're pretty unfounded. Think about it, it'd be pretty embarrassing really to either party if the price is significantly different than the IPO price because it's detrimental to one of those parties, if you will, because they have to answer to each other, so to speak. And so trying to get the number right, so to speak, makes a lot more sense. Let's talk about the next criticism, which is really market conditions. So there's been criticisms of the IPO studies that market conditions changing can influence prices, and that's clearly accurate in the sense that obviously market conditions can change, but they can change for the better or for the worse, and they change continually. Keep in mind, when a company files for an IPO, it might be 6 months to a year and a half before they go public after they file, depending upon the nature of the filing, and a lot can happen in that period of time. But what I find interesting is that most people know they're still holding an illiquid security during that whole period of time, and most people want to obviously accept a discount that reflects the fact that they're holding an illiquid security over that period of time. But as far as a criticism of market conditions impacting price, typically it's fairly sophisticated investors, and they have access to all company financial information usually. And the same with the outside firms doing valuations of stock or options at a point in time, they have access to all that financial information. So the criticism of a lot has changed, well, it might have changed, but if it did change, then it wasn't reflected in even the projections at that point. The company was providing third parties to determine a value for the company. And lastly, just as a kind of a backstop to that, keep in mind the SEC will require retrospective valuations if they think somehow the pricing wasn't correct or the values weren't correct at the time of an issuance of a stock or option. So, and those numbers are what we end up using if there's a retrospective valuation. So to some extent, there's a fail-safe there to make sure the number's right. And in today's world, let me just give you an example, I think, that's relevant. So changing market conditions. With this coronavirus that's going on that I guess maybe a month ago, we weren't even aware of, right? And so if you were valuing a coffee shop, and you can think about a publicly traded company, and obviously we're all familiar with Starbucks, and in China there's a coffee chain called Luckin Coffee, and Luckin went public last May of 2019. In the last 10 days, that stock price has fallen 20%, obviously for obvious reasons due to the increasing magnitude of that virus in China. But I would tell you that if the company were queued up to go public, it would be very unlikely that it would have been able to go public if it were queued up to go public this month or next month, based on something that's happened in the last 30 days. And so think about that with regard to, can market conditions impact pricing? Certainly, but they can also impact the ability of a company just to go public. And that's clearly one of the costs that you incur, and that's kind of built into your lack of marketability. There's a risk there that the offering won't even occur. So you just need to keep that in mind. Another criticism on the next slide is that the returns are overly large. And I think to some extent, some of the things I've just discussed kind of highlight the reason why the returns tend to be larger in that pre-IPO timeframe. There's a lot of inherent risks in the ability to even go public. And so while the people that are valuing stock and options, and even the parties negotiating for convertible preferred stock, typically have access to significant amounts of data, they can't foresee the future any better typically than the company can necessarily. And so we all tend to build in a margin of safety when we're doing something, and to some extent in the database, that does represent the lack of marketability discount. And there's a number of things here that you have to think about, not the least of which is that a number of companies that do file to go public don't make it public. So there's the failed IPO aspect, which has to be built into the sense of how you arrive at what's an inherent rate of return. So the only inherent rate of returns are successful offerings, but in the magnitude of IPOs, you also have to think about all the companies that didn't go public, and the rate of return is zero in the sense of what you're getting as an investor. And so balancing that against the ones that go public, you can see why there is, in the scheme of things, a higher rate of return, if you will, in the context of companies that were able to go public. And give you another example, if you think earlier, as I mentioned, about Casper. So Casper had filed to go public, and now they're lowering, it looks like, some of the offering prices that they're going to be able to, the offering price they're going to use in the IPO. So even their prior rounds, more recent rounds of venture investments, preferred stock, convertible preferred stock, are probably above what this IPO price is going to look like. That's a risk that you take as an investor, and so that's why these returns tend to be a little bit higher. The other thing I'll point out is, in the database, we also have negative discounts or premiums, so to speak, if you will, and so those negative discounts are another risk. That is, just because you have an offering doesn't mean the stock price is going to go up. And so, you're still funding a relatively new company for the most part. Obviously, the companies like, Reynolds aren't, but the majority of the companies that go public are still in an early stage of growth, and there's still a lot of inherent risk even once they go public. And so it's a success to have made it to that point, and the returns reflect that, but the returns also reflect all the folks that didn't make it to that point. Let me address some other frequently asked questions next. One of them is, can you give us some examples of when you would use discount data over 2 years prior to the IPO? I think the most important thing is, when you're looking at a lack of marketability, is what's the likely time frame to the liquidity event? If you think that's longer than 1 year, and more often than not with privately held companies that can certainly be the case, then you certainly should look at DLOM transactions in our database and other databases that are out beyond 1 year. we all know that as you get farther away from the IPO date, the discount is going to increase. So you have to expect that. But there's a number of factors that change from the pre-IPO date to the IPO date, and we've covered those. Economic outlook, industry, competition, those types of things. But I guess to justify the discounts and the reason you should look at beyond 1 year is you can also look at option discounts, even with publicly traded companies, and see that, in that stock option pricing, the discounts beyond the 1 year time frame, so stock option discounts in the 2+ year time frame, are a fair bit higher than obviously shorter term options. And so they reflect a lot of uncertainty in the discount, just like it would in the pre-IPO database. And so that's why if you know your time frame to liquidity is beyond 1 year, you certainly need to look at discount time frames beyond 1 year. And to the extent you've done that then, and you look at your different sources, the last thing you want to do is really discuss your subject company compared to the data you're using and then make adjustments accordingly. Because keep in mind, your subject company compared to whatever data you're using is certainly going to be imperfect, but it's the difference between that company and the data you're using that you need to describe in how you arrived at your discount. So next, I'm just going to cover, we're often asked, do we look at other methods other than just our own pre-IPO database when we're doing valuation work, and we certainly do. So in particular, we typically look at restricted stock studies, we look at the Mandelbaum factors, and we look at LEAP stock option discounts. We typically will review all of those. We'll discuss the factors from each of those in relation to our subject company, and based on that, make adjustments, positive or negative, to the reported information to come up with a final discount that we're going to use. One other thing that we tend to do in all of our reports is we'll also discuss historical factors. So, keep in mind, when we're doing valuation work, even using our pre-IPO database, the time frame is important. And I point that out in the context of some of the other discussions of lack of marketability we'll use in our report. So for instance, we'll discuss the 2008-2009 time frame as, how it created instantly a lack of marketability. We'll discuss Brexit and Brexit's impact on companies and how that created a lack of marketability. We'll look at the closely held REIT industry, and if you remember that saga, where there were a number of closely held REITs that people tried to get out of and couldn't get out of easily, and that created a lack of marketability. We'll also look at some publicly traded but concentrated holdings that were mutual funds invested in different things, and that typically the concentrated holdings were in other illiquid securities. So even though you had a publicly traded security, it held illiquid private securities. That created a lack of marketability. So we're trying to give the reader a sense of what lack of marketability is all about, and I think that helps with your discussion of all the methods you're using to kind of create a point of reference about lack of marketability and how it plays out. From there, what we'll do is then we'll just reconcile all the data and then come up with a final report. What's nice about the Valuation Advisors database is obviously it helps you paper that file. You can really drill into an analysis and show this was the starting point that we worked with, and then show what adjustments you made in your file. I think that's very helpful. Next, what we're going to cover is the 2019 results from the Valuation Advisors database, and just give you a little historical overview in the context of the slide. So this slide's a little bit busy. So first of all, I want to just point out that in 2019, we added over 700 new pre-IPO transactions based on about 130 initial public offerings last year. Those 130 offerings were actually significantly less than what was projected at the beginning of the year. There were a number of pundits who at the beginning of 2019 thought it was going to be like a watershed year for IPOs, and it turned out being more of a dud year for IPOs in the context of number of IPOs. The actual number of offerings was maybe a tad below normal, but it was much below normal in the context of what was expected. So by point of reference, slow years. 2008, 2009, there were 31 in 2008 and 63 and 2009 IPOs. And I point that out because the time period you're in makes a big difference on lack of marketability. So just the number of IPOs in our database will help you frame, hey, what was marketability like in this year? Was it good, bad, or otherwise in general? For example, in 1999, there were over 500 IPOs. In 2000, there were over 400 IPOs. So put that in the context of 170 IPOs, and you'll get a feel for what marketability was like in 1999, 2000, even versus 2019. Some differences in these years. So in looking at just tech companies, for instance, in 1999, the average IPO tech company was 4 to 5 years old. In 2018 and 2019, the average tech company was over 10 years old, or twice as old, so to speak, before it came public. In 1999, the average revenue for a tech company was about $12 million. In 2018, it was $174 million. So what this tells you is a lot of companies that are going public now have been around a lot longer. They're more seasoned, and it also means they're probably more likely to have slightly lower discounts, as you would expect. And once again, that's a reflection to some extent of the implied volatility, if you will, as well. I mean, you have much more fast-moving markets in that time frame in the late 90s, 2000. What I did is I was curious, so in our database, I ran a discount search in the category convertible preferred stock, which I'll get to shortly. But convertible preferred stock transactions in 1999 versus 2019, obviously is a 20-year differential and certainly slightly different market time frames. But in 1999, in the 0 to 3 month time frame, the convertible preferred stock discount was slightly over 40%. And in 2019, it was slightly over 17%. And the 1 year discounts in 1999 were over 55%, and in 2019 were under 25%. So it gives you a sense of, obviously, how rapidly prices were increasing in 1999, and that you had probably much greater marketability, so to speak, versus 2019, but also maybe how aberrational 1999 was versus 2019, which was a much more normal period. I'll also point out, though, that what that helps me frame is that, some of the older criticisms of the pre-IPO data are reflective of that old data. In other words, that data from that time period that wasn't adjusted, that might have had some of these other criticisms, in our database it doesn't, but nonetheless I can see how those numbers might reflect some of the concerns people would have had back then in pointing out the criticisms and the other pre-IPO sources. So next, what I'm going to do is I'm going to start into some examples of how you can use the database. This first example is, and these are just kind of random examples. I will point out that the database is really inherently user-friendly. You can slice and dice it a lot of different ways. You can keep whatever you want. You can get rid of whatever you want, recalculate it. You can shoot it over to Excel. It really is very user-friendly, and I think that's critical for your valuation file. This first example is of a structural steel fabrication company we'll call SSF, and the owner's doing some estate planning, wants to transfer a 10% interest in the common stock to a child, and typically the company does around $10 million in revenue and operates profitably in most years, but not all years. So there's a little bit of an erratic nature sometimes to the profitability of the company. So how can we attack this, if you will, from searching the database? Well, the next slide shows that the first thing we could do is just put in the word steel. That's going to obviously cover a lot of different types of companies, but we can search for just the word steel and see what happens. And so when we do that, we find there's 12 transactions in the database from 1994 to 2010. So that search isn't really too relevant to what we're trying to do. So we need to obviously expand the search a little bit. So the way we can expand the search then is to try to look at a wider sample size with regard to the company itself. So if we go to a search where we search for all companies in the database with revenues under 50 million, What this will do is this will give us every transaction in the database for companies that size. So the next slide will show you the outcome of that search, which, as you can see, this is obviously a significantly larger sample size. There's almost 8,900 transactions for companies under 50 million in revenue in the database. So this search, of course, is almost too large. It is too large at this point. We need to narrow this down. But a couple things I just want to point out. I don't know if your eyes are good and you look at the transaction date, you'll see on the transaction date that the earliest transaction in the database on this search was October 15th, 1986. That transaction, believe it or not, is actually Microsoft in the database. So in 1986, Microsoft went public. And to my point about, the difference between then and now, so to speak, of course, now we're closer to, 45 years later from that. But Microsoft, when it went public, had revenues of $143 million, about $140 million, I should say. And its operating income was $43 million. So you think about that, over 30, 40% operating margins, significantly different than companies going public today. And the discount on Microsoft in the 0 to 3 month time frame for a stock transaction was 16.7%, which isn't far off of our 20 to 25% benchmark transaction from the database. But I point that out that we obviously do have a number of transactions in this database, and you have to look at the time frame, but how the evolution of what the type of companies that can go public has occurred over the years. The other thing I'll point out about this particular slide is if you look at the 0 to 3 month time frame, the mean and median discounts are about 24 to 25.5%. That's pretty consistent with the statistics that we had, talked about earlier, and that's on the where it says additional information category there, 0 to 3 months. And then on that same schedule, you'll see in the 0 to 1 year time frame, the discounts are about 41 to 46%. So, and we're going to show you something later that'll point out there's not quite, but about a 5% incremental change over every 3 months from the first 3 months to past 1 year. And it might not necessarily be statistically relevant, but that's something just to kind of keep in mind that's useful to know. So kind of back to the search. So we're looking at SSF, and we're going to obviously narrow the search now because it's too large. So the reason it's too large is when you drill into those transactions, about 1,788 of them are companies with no revenues whatsoever, and 3,000 of the transactions are companies in the pharmaceutical, medical, and other medical industries. And then 7,300 of those transactions had operating losses. And we're trying to find a company that obviously, not all the time, but for the most part is profitable. So we can narrow the search, but let me just address a couple of these points on, things that stand out from the search. It's not unusual to see companies with zero revenues be able to go public, although the average person I don't think necessarily thinks that would be the case. But we're blessed in this country that we have a number of pharmaceutical companies and drug development companies that really don't have revenues, but get funding and ultimately turn into very successful entities. And that's how a number of the larger, biotechnology companies we have today first started. And so we see a significant number of these and have in the last 5 years. And we also see a fair bit of progress in these fields, which is very encouraging from a medical standpoint. So it's good to see money is finding its way to medical research and medical development. So back to this particular search. So how can we narrow, the results and make it more relevant? So on the next page, what we decided to do was do a search with revenues less than 20 million and that were profitable. So now we've kind of narrowed the search down a fair bit further. And so on the financial data, you can see where the arrows are that we changed our search features to revenues 0 to 20 million and profitable. And so the search results from that slide we're going to cover, but the next slide, why profitable companies? Well, first of all, they tend to mirror our company a little bit more closely than obviously all the other companies in the much larger search that we found. And that's critical. What type of company are you valuing? And does the company have a history of profitability or lack of profitability? To the extent that it has a history of profitability, you probably only want to search for companies that are profitable. If you're valuing a startup or a company that is, not consistently profitable, then maybe you want to focus on companies that are, not profitable, or do a comparison between the two companies in the database that are profitable and companies that are unprofitable. Keeping in mind that, as I mentioned earlier, even large companies that go public can lose money. Uber, Lyft, Peloton, Casper, those type of companies were able to go public and they still lost money. That's not to say they'll stay public forever if they don't make money. As we all know, at some point they have to make money, or they won't be around. So when we go to the next slide, you can see by searching for companies with revenues from 0 to 20 million and that were profitable, this provided us with 425 results. And in particular, the arrow we have highlighted shows that in the 0 to 1 year time frame, the mean and median discounts were about 40 and 45%. And there's a wide range there that you can see on these discounts. Keep in mind, we have, as I mentioned, we have both negative discounts or premiums, if you will, and discounts. And so the database numbers reflect all the discounts, even the premiums. And as you go out further, as you can see, if you look, for instance, at the 5 to 6 year time frame, you would see that those are positive discounts. You would expect that negative discounts tend to go away the further out you go, which would be to be expected, I think. So the next thing we can do with this data, if we want, would be to, now that we have a sample size that we feel might be relevant to work with, is we can kind of test the significance of the sample size and plot it against the time frame. So what we've done here is just come up with some R-squared, data. And what's interesting about this, I'm not going to get into any heavy-duty statistical discussion, but sometimes it's helpful just to do this. Now, the R-squared on this would lead you to believe that, it's kind of weak predictive ability. In other words, the coefficient of determination here, for the percentage of variance in the dependent variable here being the discount versus the independent variable time, is what's being explained, in this slide. But not a lot of it's being explained. And that's not necessarily, it doesn't trouble me necessarily, only because, as we know, there's a lot of moving parts that kind of impact these discounts prior to a company going public. And so you could list a litany of these things, but I wouldn't necessarily expect to see a close correlation in this situation, simply because of the fact that we have wide ranges in the discounts, from negative discounts to positive discounts all across the board. And so I think even on the next slide, which summarizes, the R-squared results and the standard deviation, you would see that. And so what does this really mean in practice for us? Well, it just means that, we can run a regression line through these discounts. We clearly get to see, obviously, the discounts are, ascending, which is kind of what we would expect, and that, as I mentioned earlier, the DLOM tended to increase by about 5% per month in our sample. So, the results, if you will, then you have to make a determination, are these results, helpful in the context of, our particular subject company. So what the next slide shows is that what we can do is focus on kind of the discounts around the central tendency of the study itself, or the search itself, and focus on that. And if we go past this slide even to the next one, in a perfect world, obviously what you'd like to see is something more like the slide on the right versus the slide on the left. But once again, I don't think you're ever going to necessarily see that in the context of valuation discounts for pre-IPO companies, only because there's such wide variability and so many factors that go into discounts or premiums as they are. If you could somehow one-off doing a test of individual attributes, you'd see that much more clearly, I believe. But One of the things that you could do, though, with that data set would be to say, well, let's focus on transactions within one standard deviation using the 1-year time frame only. So on this particular slide, on the left-hand side, we've got the discounts, and on the bottom, we've got the number of months. And you can see it's still fairly spread out, so to speak, but there's 130 transactions in this group, and the average discount's about 42%, similar to our initial average that we started with on the much larger sample size, and similar to the average you would expect or see from the entire database. So at least there's some confidence here that these discounts kind of make sense, so to speak. Another thing you could do then is just focus on the 0 to 3 month time frame within this one standard deviation group. And once again, the discounts here, your mean and median. Your median's 18, almost 19%. Your mean's about 15%. So if you felt uncomfortable with variability in going out further on the discount time frame, you could start with something like this as your starting point in determining a lack of marketability discount, and then focus on the particular attributes of your subject company in particular, based on all the other factors that we talked about, including looking at other, DLOM sources as well. But this clearly, in the 0 to 3 month time frame, would, if you will, wipe out a lot of noise with other things that potentially could have been going on with the company prior to going public. At this point, I think Andy has a few discussion points he wants to cover, and then I'll jump back in.
Yes, thanks, Brian. I'm just going to change the slide there to show the CE codes. Yeah, I need to remind our audience of the CE codes they'll need for the survey to receive their CPE credit. The codes for today's webinar are 6809, 7349, and 2611. Use those codes for the survey, which will appear at the end of the program. There's also a link to the survey on the registration email, and it's also on the reading page for today's webinar. Also, a question from the audience came in about our prior surveys on DLOM usage. I'll send out a little public chat message later in the program with some of those results, but they track pretty much the same, where about a third of respondents are using pre-IPO studies. And also, as a reminder, for any questions for our presenter, please use the chat feature on your screen. Okay, thanks very much. Back to you, Brian.
Okay, so I'm going to take, if you will, and just answer a couple of questions now that we have from the audience. One question was that does the IRS take the position that IPO studies do not represent fair market value? Why use these for a fair market value case? I will say that the IRS doesn't take that position in the context certainly of our database, and to that point, the IRS actually licenses our database and uses our database. So I guess I would keep that in mind. I think the criticisms, especially the older criticisms, we're going back quite a few years, were of the other two pre-IPO sources, if you will. And so I think that it's kind of like apples and oranges almost. And obviously they are licensing our database and using it. So I would say that's a pretty good endorsement of the fact that they, obviously look at our data and find it, reliable. Another question is, how does the pre-IPO study methodology reconcile with the limited partnership real estate partnership DLOM methodology? I don't know that you necessarily are going to try to kind of reconcile them per se. Part of it becomes a little bit of a pricing issue is, do you have the same number of investors, so to speak, helping set prices, and you have, the same scrutiny over the limited partnership information that you do over all the pre-IPO information. Keep in mind, all the pre-IPO information is SEC reviewed, and so I think that gives you certainly a benchmark. Not only forgetting about the IRS for a second, you have another government agency looking over all the transactions as well, and so I think that kind of adds a little bit of endorsement to the numbers and certainly the discount. Is there a general consensus as to whether it's better to use the IPO data or restricted stock data for DLOM? I don't know that there's a general consensus. As I said, we use both. I think the more ammunition you have in your arsenal to kind of arrive at a discount, the better. I think the more likely you are to show in whatever work you're doing, you looked at multiple sources and then ultimately used your professional judgment. I think that's ultimately going to serve you well, whether it's in an estate and gift tax report that the IRS is looking at or if it's in a litigation matter. I think it just shows a lot of professional discipline. Does the database identify the stage of a company in its life cycle? The database doesn't, but what you can do is, you can obviously go back to the source document of the prospectus itself, the 424B4, the S1, and it'll give you a history of the company. And so if you're concerned about kind of a time frame, that would be the only way to really kind of drill into it. And even that, it may or may not be helpful. You have a number of companies that go public that have been around a long time, and it's like, so think of Reynolds as an example, and I don't know that's relevant, and yet you have a number of companies that, in the Casper situation, that haven't been around a long time. So we're going to get to an example that kind of shows another thing you can do with the database, really outside the context of discounts even, but I think if you're looking for the average age of a company, so to speak, or even an industry, you probably want to go into some of the IPO filings for different companies in an industry and just do a little bit of research there. I think that would help answer, if you will, that question for you. I'm going to get into example number 2 now. Example number 2 would be a situation where you've got a trust. You can think of a grantor trust, something along those lines that holds an LLC as one of its assets, and the LLC operates a $20 million cash and securities portfolio, and for simplicity, we'll say that it's made up of 50% publicly traded stocks and 50% bonds. And you've been asked to value a 10% interest in the LLC units for gift tax purposes. So keep in mind, you're valuing the LLC. The trust holds it, but you're valuing the LLC itself. So the first thing you could start by doing is, looking at kind of some subsets of data for the overall results. And so, one of the things you might look at would be investment advice. Now, it's a little bit different. Obviously, you've got an LLC holding direct investments, and then you've got companies that went public that were providing investment advice. So we did a search just of that category, investment advice. And we searched for 0 to 1 year transactions. There were 30 transactions in that group, and that gives you the mean and median discounts in that transaction group, and then the R squared, once again, which isn't necessarily statistically relevant here, and then the plot of these discounts. So these discounts would probably be consistent, if you will, with what we know a typical, the discount might be for a shorter time frame. So what this would tell me is that the discounts in general for, investment advice industry participants are lower than the average discounts in the database. So were the subject companies that we determine the discounts from similar to our subject company? In this case, you can see, the revenues and assets sizes were significantly higher, let's say, than what our subject company would look like. So these companies are much larger, and therefore we'd have to try to ferret out the fact that they're much different than our subject company. So how do we address that issue? So on the next slide, what we've done is we've shown you that if we decided to do a general search of companies that were similar in size to the companies from our first search. So what we're going to do now is we're going to search for other companies that were similar to the investment management companies to see if there's a difference between discounts of the investment management companies and other similarly sized companies. So in particular, what we did is we searched for companies with revenues from $100 million to $2 billion that were profitable and that had assets from $200 million to $4 billion. So it's a pretty wide search, again. And we're just trying to see what this turns up in relation to, our investment management firm. So now we turned up 643 transactions, a significant number of transactions. Mean and median discounts, obviously higher, somewhat. And If you look at the range, which is probably hard for you to see on that slide, but the range has negative discounts to premiums, and it's a pretty wide range, and so don't be distracted by the range. You're really looking at the kind of median level discounts. And you'll see that for the most part, those median level discounts do slide as you get further away from the IPO. The negative discounts included, in this situation, 2 pharmaceutical companies and a renewable energy company and other companies that at some point prior to the IPO, maybe a fair bit prior, had significant either progress or significant hope maybe for a pharmaceutical product or maybe an energy discovery or something along those lines that later didn't pan out to be quite what they had hoped. Nonetheless, they still wanted to go public and needed funding. The result is that the prior investors had paid a price for that stock or the convertible preferred stock or issued options at a much higher number. So the IPO price, if you will, was underwater, so to speak, compared to that. And that isn't atypical necessarily for a company who doesn't pan out and yet still, needs capital to go public and has the ability to still go public. More often than not, in that situation, those companies don't end up going public. And so, I think, as Shannon would have said, what's that discount? It's infinite, so to speak. So the next slide, what we did is we took that data set and the prior data set, and we compared the large companies, which was the 643 example, to our investment management firms, and then we did a comparison. And so when we move to the next slide, you'll see the discounts over 1 year were between 2.9% and 5% lower for the large company group, versus the asset managers. So you can see the asset managers, as we noted, had lower discounts than the large company group, which seemed to be kind of implicit from the first slide we looked at, which those discounts tended to be lower than what we'd seen overall in the database to begin with. Now, one of the explanations for this might be that typically asset managers are generally profitable, and those profits tend to be somewhat more predictable, which would result in lower risk and lower variability of results. So we would expect to see discounts, for those types of companies lower on average than for the database in its entirety. So the next thing we can do, in the next slide we're going to show you, would be for a company of this type or a valuation in an industry of this type, what we think is very helpful with the Valuation Advisors database are the convertible preferred stock transactions. Convertible preferred stock, obviously, as you know, is stock issued typically by a sophisticated investor to pre-IPO companies in return for capital. And typically, the convertible preferred stock has, obviously, a conversion feature to common, but also has some type of income associated with it, typically a dividend, some type of a coupon where the holder is getting something, which tends to mitigate the risk a little bit. So it tends to, if you will, trade, not that it trades, but it tends to be treated, if you will, a little bit like an income security. And to some extent, in the context of valuing a holding company that has other marketable securities, we would look at that as being a pretty good source for arriving at discounts. So the next search we did was we looked at companies in the database, pre-IPO companies with revenues from 0 to 100 million, and searched just convertible preferred stock transactions. This search turned up 93 transactions in the database, and what this provides you with is the mean and median discounts within 1 year. So you'll see that 45 to 55 range is still pretty consistent with the overall database. And so in the context of, trying to make some determination of what your discount might look like, keep in mind these are convertible preferred stock transactions. They're not common stock transactions, and so you have to factor that in. In theory, these discounts will be a little bit lower than a common stock transaction, and so that would adjust the number upward a little bit. We also know that the type of company you're valuing tends to be a little less risky, and those discounts reflected that, which would tend to knock the discount down a little bit. And then the other thing to keep in mind is even with the larger searches, that there are still negative discounts, which tend to bring these numbers down, so to speak. And in the context of the 0 to 3 month time frame, which I thought would be helpful for you to know, in the database, looking at convertible preferred stock transactions, in just the 0 to 3 month time frame, there's about 10% of those transactions are negative discounts or premiums. And in the overall database, it tends to be a little bit higher, 15 to 17%. So a significant number of transactions in the database are actually at premiums, which tend to lower if you're looking at historical average numbers and median number, average numbers, I guess, lower the averages and don't impact the median quite as much. But just keep that in mind. So going back to this example, so what are the applications of the information we have so far? So, well, we know the relative differences are that the discounts for an investment management firm are lower than similarly sized companies, which would include every company in the database. We also know that DLOM best practices would suggest that you can't rely on simple averages. So what you would want to do here would be to look at the particular company you're valuing, in this case, a company that holds marketable securities, which makes it less risky, and you would probably end up lowering your discount, everything else being equal, for that fact, although, as we all know, there's a lot of other factors you would look at in the context of arriving at lack of marketability. But we do know that this type of entity, and the convertible preferred stock points that out, would tend to have lower discounts. The next example I'm going to cover is a situation where we're often asked, what can you use the older data in the database for? Aside from just the fact that, as we know, the longer you get away from the IPO date, the more noise there is and all kinds of things that have happened, between that time and the time the company went public. And we also know that, in particular, for early stage companies, there's typically a lack of revenue. There might be less reliable projections. There's more limited market comparisons, those types of things. So if you're asked to determine the value of a company with some of these features, obviously, you need to have some starting point. And so the AICPA recommends what they call the benchmark method. And the starting point, hopefully, you have some number already out there, maybe some prior funding round, something that's arm's length that you can start with. So if you have something like that, what you can do is you can look at changes in value from companies in the database to help you maybe, triangulate a value for the subject company you're being asked to value. So let's look at an example. So in the database, there's thousands of early stage companies that we have discount data for over a long period of time. And so if you were engaged by an early stage biopharma company to assess its likely current value of its equity, and the parameters were this: the company had no revenues, had some significant research progress, and a value based on their initial equity financing 10 months earlier. So companies come to you and said, hey, how do we help us determine the value of the company? And you're going to ask for all the requisite things, projections, and obviously, what's the nature of the research and the medical product they're working on, all that. But the long and the short of it is, they can't give you clarity. They can just give you, maybe likelihood of outcomes, good, bad, and otherwise outcomes. So what do you do in a situation like this? Well, one of the things you can do would be to search our database and look at companies that went public with zero revenues. So you can see, obviously, on the search line, in this case, you can go to a SIC code or a NACS code. In this case, we use the NACS code for pharmaceutical preparation manufacturers, and we put in zero revenues. And this search yielded about 1,230 transactions. But in this case, keep in mind, we're not interested so much in the discounts as we are the change in the price over time. So what we're going to do is we're going to look at the data we want, and we're going to sort that data into whatever data we want, and then we're going to download that data into Excel. And from there, we can much more easily work with the price data that's in the database. So the first thing you do, sort it by company name, and then by transaction date, oldest to newest. And we pulled out a transaction for you here for a company called BioBridge that went public, and this shows you on their convertible preferred stock the transaction price at 3 different intervals. So you've got 3 to 4 years, 2 to 3 years, and 7 to 9 months before the IPO. Once you've gone through this process and you've selected a larger sample group, you can then obviously calculate the implied change in value or the appreciation in value or depreciation in value over time for a number of companies. And so, that's what we've done. And in this situation, you can see here's your implied change in value from different points in time and the change in price. You could then take the sample group you're working with and this implied change of value, at least as a point of reference to your subject company, to have some justification for saying, well, this looks like, based on our sample company, and keep in mind you're trying to find samples that are close. We started with a large sample size here. You would winnow this sample size down, so instead of 1,239, you'd probably winnow this down quite a bit. You could search it for asset size. You could search it for all kinds of different features. But nonetheless, you would be able to come up with an outcome that shows a change in price for a company with no revenue over a period of time as a justification, at least, one of the tools in helping you decide what's the likely increase or decrease in the equity value of the company at 2 different points in time. So in conclusion, what I've tried to show today is just a lot of different ways you can use the database. As I mentioned, it's by far has the largest number of transactions for lack of marketability in the world. You can use it in a lot of different directions. You can use it obviously for lack of marketability data directly. You can use that in the context of option stock or convertible preferred stock. Convertible preferred stock is especially helpful in the context of an entity holding securities that have some type of a coupon or dividend. So if you think about a FLP or LLC and estate planning, that's especially helpful in that regard. The data is all reviewed, obviously SEC reviewed and reviewed by us as well to make sure that the data is accurate and that it's reflective of fair value or fair market value as appropriate. The convertible preferred stock, as I mentioned, there's about 450 transactions in the database. It's pretty significant. And at a bare minimum, I find those transactions to be especially helpful because those are often between very sophisticated investors with access to all kinds of information, and it's typically a very arm's length negotiation between parties as to funding, putting a significant amount of money into a company for stock or convertibility into stock. And I think those are great transactions aside from stock and option transactions. I think in general, what the database provides you is a large sample size to work with in a lot of ways that other competing databases might not provide you with. And sample size is important in the context of being able to come up with results sometimes. I also think that it's truly market-based, which is critical. You can't argue against an IPO price. We know sometimes that price might be change up or down a little bit, but the IPO price is the IPO price. And we know that if the data before that's being SEC reviewed and looked at, that's good data as well. So then the discount should be a pretty good indicator of obviously a true discount. And people can argue other factors other than just pure liquidity, but keep in mind, if you're valuing a privately held company, all those other factors come into play in the normal context of owning shares in a privately held company. And I think that's important to remember. I also think that the database itself is useful in the context of pointing in the direction of industry information. So in addition to searching for the lack of marketability data, you can then get a sample size of companies in an industry, and then if you want to, go back to the original source documents and drill into that industry a little bit more. And there's a lot of useful information there, to say the least, of just competitors, potential competitors that are out there, or a comparable group you might want to work with. But it'll give you a sense of margins, growth prospects, and things like that. And keep in mind, if it's an older prospectus, the company still files a 10-K every year for their annual filing, which is going to give you a pretty good indication of what's going on with the company and the industry as well. So it'll save you, aside from just providing you lack of marketability discounts, it'll provide you a good starting point for your industry discussion as well, which I think is very helpful. So that is the conclusion, I think, of our database. I think it'll save you a lot of time and effort in a lot of the things that you'll do, and it'll provide you a great source of documented discounts to, paper your file with. And as we know, third parties that may be looking at your work are also using it. The database is used in over 16 different countries. It's used worldwide. It's used by all the large valuation firms, all the large accounting firms. And so I think it's something that would be a good, tool to have in your arsenal of DLOM. And with that, I'm going to take a look at whatever questions we have in and try to address more questions for you as well. One of the questions was on the particular example we used in the steel industry, and we started with less than 50 million without industries identified. How do you bring that scope to 50 million back to this specific industry? Well, I think what we're trying to do with any search is, you're just going to pick a size to start with. Keep in mind, you can put in a number, and if that number provides you with too much detail, you can narrow it down more. And so really what you're trying to come up with is what you think is a fairly accurate representation of your subject company. So if your search sample size ends up being too large, it's easier to narrow it down. So in a perfect world, you're going to start with more of a broad search and then narrow that search down a little bit from that size to get to something that you think is representative of what you're looking for. I think one of the other things that you just want to keep in mind is that the timeliness of the database. There's a lot of information that's out there, but not all of it is as timely as the Valuation Advisors database. We are very diligent about making sure that the data is updated monthly and typically by the first week of the next month. And so not only is it a significant database in the context of transactions, but it's also timely and relevant. And I think that's very helpful when you're trying to do the current valuations, or even if you have to go back and do a historical valuation. You can certainly look at information at that point in time and search for a time period, a 6-month time period, a 1-year time period, a 2-year time period. So there's a lot of ways that you can slice and dice the data to get it to something that you feel is usable and very appropriate to your particular transaction. So one of the questions was, how do we treat outliers? We don't treat outliers in the context of, we provide you with all the data. There are going to be outliers. There's going to be significant positive discounts, significant negative or premium discounts. We provide the data. We don't so much scrub the data at all as let you do that. So in the context of looking at maybe 500 or 1,000 transactions, if you see outliers, it's kind of up to you to decide, do I want to get rid of certain outliers. We can't explain the outliers necessarily, other than we can look at it, maybe figure out why a discount seems somewhat aberrational, but we don't know all the circumstances behind how those prices were arrived at a point in time, other than typically if it's a premium or a negative discount, something bad's happened in the life cycle of the company that has forced it to lower its value significantly over time. We still provide that to you, and you figure out if that's something that you want to ignore. We also, think it's important that you consider, as I said, the time frame to liquidity. And there's a lot of ways you can look at that, but more often than not, how long does it take for your subject interest to sell? And that's the more important thing. And so once you know that, you can frame, if you will, your discount time frame much, much better. And then from there, so you could start with a time frame, if you will, and you can go in and search the database for a particular time frame. You can say, well, just give me everything from 1 to 2 years, or you can give me everything from 10 to 12 months, and start with a large sample, and then continue to drill down smaller, 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 until you get what you're looking for that's very targeted for the type of company. And then you can send that over to Excel, and obviously from there you can do some of the statistical analysis you might want to do as well. And there's a number of statistical analysis and graphs you can obviously work with in Excel if you want that to help paper your file a little bit. Next question is it realistic to use this approach for very small companies, say under $2 million in revenue? I think it's very appropriate to look at the database for all types of companies, whether they're large or small. But keep in mind, you can go into the database and you can search for companies that are very small as well as companies that are large. So the size of the database isn't a factor in the sense of it. I think it helps you with all types of companies. So, and just to answer that question, I just went into the database as I have it open, and I searched for companies with revenues under $5 million, as an example. And there's 3,750 transactions for companies under $5 million in revenue, which tells you, I think, that even for smaller companies, there's a significant number of transactions in the database that are useful. And that's very important, obviously, if you're valuing a smaller company and trying to figure out lack of marketability. And as we know, that time frame sometimes tends to be longer for a liquidity event than a larger company. So we use it in our firm for all different purposes, and I think it's very helpful in that regard, whether it's a smaller company or a larger company. I think that's it at this point for. I got another question that just came in. Can you talk about how the pre-IPO studies have fared in the courts? Well, it's interesting because there hasn't been a lot of pro or con recently, although there was more recently a favorable court case. There's been a few where the pre-IPO studies were referenced in the case and arriving at the lack of marketability discount, and ultimately the taxpayer's discount was accepted by the tax court. So in those cases, the pre-IPO study, they don't reference which pre-IPO study was used, so we don't know if it was the Valuation Advisors database. But the court clearly acknowledged the usage of the pre-IPO studies and the acceptance of the pre-IPO studies. We haven't had negative results from a court case with the Valuation Advisors study ever. And I think that's important. In other words, the results that were referenced that were negative, and we're going back now, almost 20 years, were with other pre-IPO studies, I'll call them, not even databases. So I think there's a big difference between the way we've built our database and the older pre-IPO studies in the context of court cases. So obviously we use the database in all our valuations, and I would highly encourage everyone else to do that as well, especially since, as you know, the party that might be looking at your valuation, report is also using the database, and so they have access to it, and they have a sense then of, obviously, what discounts look like, and can work with it in the context you could work with it and slice and dice it and come up with different things. And I think that's good to know as well, that the IRS licenses the database. We'd like to think that, they're using the same tools we're all using, and that, if they are, and we're all using, our professional judgment and looking at all the data that's out there, then, the numbers should make sense. That there shouldn't be significant aberrational valuation results in the context of for being professionals. So, the single user license to license the database is $699, and if you're not a user, I will just tell you that I think it's a significant bargain in the context of being able to substantiate your DLOM and have that in your file, especially if something gets looked at several years down the road, and you can easily pull it out and show the process you used as one of your pieces of the DLOM puzzle to arrive at a discount. So I'd like to thank everybody for being on the call today. I'd like to obviously follow up in the context of, I always tell our subscribers, if anyone does have a particular question, you can email us directly as well, or email BVR. We're very good about responding to particular subscriber questions on lack of marketability. Thank you.
Brian, if I might ask or just clarify a question. There was a question before about the IRS's position, and I was wondering whether that perception came from the IRS DLOM job aid that came out a number of years ago. Do you know that? I was just wondering if that is one of the
Well, it could be.
misconceptions.
Yeah, once again, I think you'll see that we're not referenced directly in the job aid. The Valuation Advisors database isn't referenced directly. In other words, I think that there's some of those older kind of misperceptions have easily get carried through the profession sometimes.
No.
And that's why I think it's really helpful that everyone's kind of educated as to, in our database, we don't have a lot of those deficiencies that I think have been previously referenced as being in the pre-IPO studies. We actually, went to the point of making sure that we were addressing anything like that. So I think the only thing that I would say that in any database, there's always going to be things that you can do pros and cons of. Time frame is always an issue. There's multiple factors that go on before an IPO, leading up to the IPO. But the thing that I think everyone has to remember is that those discounts are based on transactions that have been SEC reviewed often and, have been prepared typically by valuation firms with access to company data that should have reflected at that point in time all known future information and projections from the company. So that kind of mitigates, I think, the time frame issue a little bit as well. And I think that's really the only real criticism you can come up with of, the pre-IPO data. So I think from our standpoint, I think it's extremely useful and extremely helpful, and it's really market-based, which is critical in the context of what we do.
Yeah, and also just speaking about that job aid, I mean, I think a point should be made that those documents are not official IRS positions. Those are internal documents used for training, and I mean, according to we did a webinar with Mike Gregory, who was the champion of the job aid, and they're not to be used. They're not to be used or cited as authority for any legal position. So I think the audience needs to understand that.
Yeah, I think if you were in a situation where that were the case, I think it would be easy to say that, especially if you're using our database, that any of those criticisms aren't appropriate in the context of our database, and I think that would negate that pretty quickly.
Yeah. Also, in some recent articles, I think that I had in BVU, I think I pointed out that the authoritative textbooks that people normally point to generally support the use of pre-IPO studies. I know the Shannon Pratt book does, and I think I had a quote from there, and the Gary Trugman's book speaks about it, and also the ASA certification courses speak of them and the restricted stock studies as important tools, but like anything else, they have to be used in a knowledgeable fashion, but that they should not be automatically discounted. Is that a fair statement?
That is a fair statement. We try to tell everyone, we provide you a lot of ammunition in the database. You really don't want to just do a quick search and rely on averages. Really what you're trying to do is show your professional judgment, and so you want to take the data and make it as appropriate as you can to your subject company or the interest being valued. And then in your report, you want to discuss maybe the changes you've made or the adjustments you've made to the data and why, because ultimately that's what you're being paid to do as a professional. So what we're trying to do is give you as much ammunition as we can in the data itself. And the data, says what the data says. It's your job to take that data and figure out how does this apply to the valuation of the interest that I'm doing. Obviously, we're trying to give you as strong of data to start with as you can, and I think that's important.
Well, it's terrific, and you said it earlier in the program. The more data you have to support your opinion, all other things being equal, the better off you're going to be. So I think this just reiterates that point. So thanks very much, Brian. I don't see any other questions in the queue. So unless you have any other remarks, Brian, we'll wrap it up.
All right. No, I don't. Thank you once again. If anyone has follow-up emails, by all means, just send us an email. And thank you very much.
Okay, thanks, Brian Pearson, for a very, very fine presentation, and thanks to our audience for attending today. As a reminder, to receive your CPE credit, you must complete and submit a brief survey on this webinar and include the 3 codes, which are 6809, 7349, and 2611. Again, those codes are 6809, 7349, and 2611. The survey will appear on your screen at the end of the program, and there's also a link to it on your registration email, and it's also on the reading page for today's program. The survey will be active for 5 days and must be completed before we can process certificates. After 5 business days, we'll process all surveys and send CPE certificates by email. You can find more information on future BBR webinars at bbresources.com/training. Our next program will be next week, Thursday, February 6th, where we will talk about the valuation of adult cabaret businesses, such as gentlemen's clubs and other types of entities such as that. Please join us for a very interesting discussion of an entity maybe you haven't come across in an engagement before. That'll be next week, Thursday, February 6th. Hope to see you then. Again, thank you all for attending. Have a great rest of the day, and you may now disconnect. Thank you.